Welcome to the Deep Dive. We're the place where we take those really complex ideas, wade through, mountains of information, and try to boil it all down to the core insights for you. Today, we're setting off on a pretty fascinating exploration. We're diving into the mind of someone you could really call an investment philosopher. His insights go way beyond just crunching market numbers. It's deeper about human nature, decision-making, especially when things get uncertain. Before we really get into it, though, just a quick practical note. If you're trying to get a feel for the overall market temperature right now, maybe spot potential bubbles or bargains, you might want to check out the Buffett Indicator app. Yeah, just search for Buffett Indicator on the iOS App Store. It gives you daily updates on that, famous valuation measure. It's just another tool, another lens to view things through. And hey, if you find this deep dive useful and you want more like it, especially on topics like value investing, make sure you subscribe to the Deep Value Investing channel. We're on Apple and Spotify podcasts. Oh, and check the episode description.
We always put a curated book list there if you want to, go even deeper into the reading. Now, the important bit, the disclaimer. Everything we discuss today is based on publicly available info, purely for educational purposes. It is absolutely not investment advice. Seriously, always do your own thorough homework before making any investment decisions. Okay, all right, let's unpack this, our mission today. To really explore the investment philosophy of Howard Marks. He's the co-founder of Oaktree Capital Management. But he's not just a hugely successful investor. He's also a really insightful writer. His client memos are legendary, and his book, The Most Important Thing, it's basically a cornerstone text. Taken together, they offer this incredibly coherent way to think rationally and make sound decisions, especially when you're facing uncertainty. And you might think, this is just finance stuff. But honestly, as we'll see, Marx gives us something much broader. It's like a practical modern philosophy, almost an operating system for your brain, really, that you can use to navigate complexity in pretty much any part of your life.
We've got some great sources today, pulling directly from his own writing and analyses of his key ideas. So let's jump in.
Yeah, what's so compelling about Howard Marks, I think, is how he just elevates investing. It's not just about spreadsheets and economic reports in his world. He really turns it into this rigorous discipline. It involves critical thinking, sure, but also a ton of self-awareness and understanding behavioral psychology. He genuinely sees the investor, the successful investor, as a kind of modern philosopher. And his work provides this guide, not just for markets, but maybe even more crucially for understanding ourselves. Our biases, our fears, our moments of irrational exuberance. So today, we're going to walk through 5 core principles. These really form the bedrock of his thinking, and we'll explore how these ideas, these powerful concepts, echo far beyond Wall Street and how you can actually use them in your daily life. Core philosophy of war. The imperative of second-level thinking.
Okay, kicking this off, we've got a concept that is just. It's foundational to everything Marx talks about. It's called second-level thinking. Now, I know it maybe sounds a bit like spy jargon or something from a psychology textbook, but the implications for making better decisions are just immense. So let's peel back the layers here. What exactly does Marx mean by this, and why is it so important for you, the listener, whether you're planning a career move, buying a house, or, yes, making an investment?
Yeah, that's the fundamental question, isn't it? How does anyone consistently get superior results? Results that are clearly better than average, better than what most people manage. How do you do that if your thinking isn't also superior? If it's not genuinely different and, crucially, better than the average person's thinking? Marx makes this really logical point. If you just think like everyone else, if you adopt the consensus view, the best you can possibly hope for is average returns. It's almost definitional. And this isn't about like raw IQ points. It's about a different kind of thinking. It's about the ability, the discipline really, to think differently and much deeper than the crowd. It's a deliberate cognitive leap. So let's break down these 2 levels he talks about. First, there's first level thinking. This is the kind of shallow, superficial, almost reflexive way most people approach things. The sources nail it. You see a company report great earnings, and the immediate thought is, wow, good company, let's buy the stock. Simple.
Right. Or seeing a trend take off and thinking, everyone's doing it, must be the right move.
Exactly. It looks for easy answers, simple formulas. It focuses on what's right there on the surface, what everyone already agrees on. It doesn't require much effort, frankly. But the problem is, because everyone does it, any insight you get from first-level thinking is already known. It's already baked into the stock price, or it's already part of the general consensus. The edge is gone.
So it just leads to average outcomes.
Pretty much. Now, second-level thinking. This is where the real potential for an edge lies. This is where the magic can happen, so to speak. It's deep, it's complex, it often feels convoluted, precisely because it's wrestling with multiple layers of reality and, importantly, human behavior. A second-level thinker doesn't just react to the obvious headline, positive or negative. No, they dig in. They consider a whole host of factors, often contradictory ones. They think about the entire range of possible future outcomes, not just the one they hope for or the one that seems most likely right now. And they try, however imperfectly, to assign rough probabilities to those different scenarios. And here's a key step. They actively analyze what the prevailing consensus view is. What does everyone else think about this stock, this situation? Then they ask that vital question. Okay, how does my assessment, my expectation differ from that consensus, and why? And finally, they think about how the current price or the current state of things already reflects those different expectations, including, the underlying psychology, the greed, the fear, the complacency that might be driving the consensus.
Okay, can you give us a concrete example? How does this play out?
Sure. So the source kid's a great one. A first-level thinker sees a company whose products are everywhere, great brand recognition, and says, it's a good company, let's buy the stock. Straightforward. But the second-level thinker goes deeper. They might say, yes, it is a good company, but everyone thinks it's a great company, maybe even an unbeatable one. And it's probably not that good.
Ah, so the expectations are too high.
Precisely. The market consensus, they might continue, has already priced in years and years of absolutely perfect growth. So the stock, despite the company's quality, is actually way overrated and overpriced right now. Therefore, it's actually a compelling sell, or at least not a buy.
Wow, that's completely different. It's inherently contrarian.
Exactly. It's not just about finding good things. It's about finding good things that are underappreciated, or, just as importantly, identifying widely loved things that are overvalued compared to their real prospects. It's finding value where others are blinded by hype or despair. So the key takeaway, the really profound implication here is this. If you want superior results in anything, really, investing, business, even personal choices, you absolutely have to think differently and better than the consensus. Now, this is incredibly difficult, let's be clear, because honestly, the consensus is often right, or at least it's right for a while.
Yeah, going against the grain feels risky.
It is. Marx is very clear. Extraordinary performance only comes when you hold correct, non-consensus views. That means you have to be right when most others are wrong. And this whole philosophy rests on a core belief that markets, because they're made up of fallible humans driven by emotion, constantly make mistakes. Prices diverge from true value. Situations get misinterpreted. These mistakes, these gaps between perception and reality, are precisely what create opportunities for those disciplined enough to apply second-level thinking. If markets were always perfectly efficient, if everyone always acted rationally, well, there'd be no edge to be found.
So it's less about just being smart in the traditional sense or having some secret information, and more about developing this specific intellectual habit, the ability to step back from the noise, the echo chamber, and critically assess what everyone else just accepts. And that sounds like it takes serious psychological strength. Going against the herd, especially when the herd seems to be winning, must feel incredibly uncomfortable, isolating even.
You've absolutely nailed a critical point there. It highlights this huge psychological hurdle. Second-level thinking forces you to actively resist that powerful, innate comfort you get from being part of the crowd. You have to fight the urge to conform, especially when your unconventional view looks wrong in the short term. Imagine holding a stock everyone else is dumping, or selling one everyone else is piling into.
Oh yeah, that sounds stressful.
It is.
Yeah.
The market can stay irrational longer than you can stay solvent, right? That divergence can test your conviction to the absolute core. So it demands not just the intellectual horsepower to develop that deeper insight, but also immense emotional discipline. You need the guts to stick with your analysis, even when doubt creeps in, even when you feel alone. You have to trust your process over the fleeting sentiment of the moment. Marx captures this challenge perfectly in a quote. He says, for your performance to diverge from the norm, your expectations and thus your portfolio have to diverge from the norm, and you have to be more right than the consensus. Different and better. That's a pretty good description of second-level thinking.
Different and better. That sums it up.
It does. And he even offers this like a simple but brilliant test for any investment idea, or really any popular notion. Ask yourself, and who doesn't know that?
Huh. I like that.
Yeah.
And who doesn't know that?
Yeah. It forces you to constantly question the obvious. Is this insight truly unique, or is it just common knowledge already priced in? It pushes you to seek perspectives that aren't universally held.
That's a great filter. It really makes you stop and think, how often do we just go along with things because they seem obvious? Whether it's, adopting the latest tech gadget, following some diet trend, even accepting a political narrative without question. This idea of digging deeper, questioning the consensus, looking for that unique angle, it really does have implications far beyond just finance. It's about cultivating a more critical, independent way of seeing the world. Core philosophy the second, mastering the market cycle. And that notion of independent thinking flows perfectly into the next big principle from Howard Marks. This one dives into the fundamental rhythm of markets, economies, and frankly, a lot of life itself. The cyclical nature of things. I mean, we see cycles everywhere, right? Fashion, technology adoption, political moods, even our own energy levels ebb and flow. Marx argues this cyclicality isn't just present in markets, it's fundamental. And understanding it is absolutely key.
Yeah, if you want to grasp Marx's overall worldview, you have to understand his deep conviction in the reliable, almost inevitable existence of cycles. He famously says, quite simply, most things will prove to be cyclical. Now he's quick to add, you can't predict their exact timing or how long they'll last or how high or low they'll go. You can't set your watch by them.
Right, it's not like clockwork.
Not at all. But their existence, that, he argues, is reliable. Cycles are just an inherent feature of economies, industries, and especially markets. He often quotes Mark Twain to capture this idea of patterns repeating without being identical. History doesn't repeat itself, but it does rhyme.
I love that quote.
It's perfect, isn't it? It suggests that while the specific details change the companies, the technologies, the geopolitical events, the underlying patterns, driven by unchanging human nature, our hopes, fears, greed, and basic economic forces, tend to recur with remarkable consistency. The plot might change, but the emotional arc, the oscillation between extremes, feels very familiar time and time again. And Marx frames these cycles not just as ups and downs, but more dynamically, as oscillations between periods of excess and the inevitable corrections that follow. This framing is crucial because it highlights a kind of cause and effect relationship within the cycle itself. As he puts it, the events in the life of a cycle shouldn't be viewed merely as each being followed by the next, but much more importantly as each causing the next.
Okay, unpack that. How does one part cause the next?
Well, think about it. Long periods of success, widespread optimism. What does that breed? Overconfidence, right? People start taking more risks. Lending standards get looser. Capital becomes easy to get. Those are the excesses. But those very excesses, the over-optimism, the risky behavior, inevitably sow the seeds for the next phase. Disappointment, corrections, pessimism, fear, tighter credit. And conversely, when things are terrible, when pessimism is rampant, everyone's given up. Well, that creates the conditions for the next recovery. Prices are low, expectations are low, the bar for positive surprises is on the floor. It's a self-perpetuating mechanism driven largely by our own behavior.
Okay, this is where it gets really interesting for me, because it sounds like Marx is saying these cycles are less about, say, the latest jobs report or GDP number, the stuff we usually focus on, and much more about us, our collective feelings, our psychology.
That's exactly his emphasis. He stresses that these cycles are driven far more by the persistent, predictable swings in human psychology. The pendulum swinging between euphoria and depression, greed and fear, optimism and pessimism, risk tolerance and risk aversion, than by the underlying economic fundamentals alone.
So the economy might be okay, but the market sentiment drives the bigger swings.
Often, yes. The economic data provides the backdrop, but the emotional oscillation is the engine driving the cycle to its extremes. And this emotional roller coaster causes most investors to behave, unfortunately, in a pro-cyclical way, meaning they get caught up in the excitement and buy near the top when optimism is highest and prices are inflated, and then predictably they get terrified and sell near the bottom when pessimism is thickest, locking in losses.
Buying high and selling low. The classic mistake.
The classic wealth-destroying mistake. Marx uses that great metaphor of the market as a pendulum. It's always swinging between these emotional extremes. He says, investment markets follow a pendulum-like swing between euphoria and depression, between celebrating positive developments and obsessing over negatives, and thus, between overpriced and underpriced. It's this powerful, predictable, emotional tide that pushes markets too far in both directions, creating the very opportunities the second-level thinker looks for.
Okay, so if we know these cycles exist, but we can't reliably predict when the pendulum will swing back or exactly how far it will go, what's the practical use of this knowledge? How do we actually use this insight without just getting paralyzed, waiting for the perfect moment that never arrives?
Yeah. Right, that's the critical question, and Marx is very clear here. Since you can't predict the timing, the focus shifts. It's not about predicting turning points. It's about knowing where we stand in the current cycle. His mantra sums it up perfectly. You can't predict, you can prepare. It's not about having a crystal ball. It's about developing sharp situational awareness and adjusting your strategy based on that awareness.
Okay, so prepare. What does that look like in practice?
Preparation in this sense means constantly taking the temperature of the market. You're observing things like investor sentiment. Are people generally bullish or bearish, complacent or fearful? You're gauging risk aversion levels. Are investors eagerly embracing risk, or are they shying away from it? You're looking at capital availability. Is money easy and cheap to borrow, or is it tight and expensive? And critically, you're evaluating valuation levels. Are assets in general looking cheap, fair, or expensive compared to historical norms and underlying fundamentals?
So it's like being a weather forecaster, but for market psychology and conditions.
That's a great analogy. And this awareness allows you to adjust your posture. You become more defensive, maybe raise cash, trim risky positions when the signs point to excessive optimism, high valuations, and low risk aversion. That's when the market is vulnerable. Conversely, you become more aggressive, deploying capital, looking for bargains when the pendulum has swung the other way, when pessimism is rampant, assets are hated, and prices are depressed. Marx argues that the greatest opportunities often appear at these extremes, precisely when most people have forgotten that cycles even exist. They get convinced that this time is different, that the current trend will last forever.
The four most dangerous words in investing.
Exactly. He even describes 3 stages for bull and bear markets to help recognize these extremes. A bull market starts with a few smart people realizing things might get better, then more people catch on as fundamentals improve, and finally it ends in widespread euphoria where everyone believes prices can only go up and risk is ignored. A bear market follows a similar pattern in reverse. Early recognition of problems, then widespread realization, culminating in utter hopelessness and capitulation, where everyone just wants out at any price.
Recognizing those stages seems key.
It is. It helps you know when to lean against the prevailing mood. Be cautious or sell into that final stage of euphoria. Be aggressive and buy into that final stage of despair. The real value isn't predicting the exact turn, but recognizing where you are in the emotional and valuation cycle and adjusting your odds and risk exposure accordingly. You're basically positioning yourself to benefit from the predictable irrationality of others.
So it's about adjusting your sails based on the prevailing winds, rather than trying to predict exactly when the storm hits or the calm arrives. That feels like a much more sustainable, less anxiety-inducing way to operate, doesn't it? Core philosophy the third, the primacy of risk control over prediction. When we think about risk, most of us probably jump to things like, market volatility, how much the price bounces around, or just simply how much money could I lose. It often gets boiled down to numbers, standard deviations. But Howard Marks, true to form, has a much deeper and frankly more useful perspective on risk. He actually says risk is the most interesting, challenging, and essential aspect of investing. That's a strong statement.
It is, and it signals how central risk is to his entire framework. What's really fascinating is how he fundamentally challenges the standard academic definition of risk, which often just equates it with volatility.
Right, the beta, the standard deviation stuff you learn in finance class.
Exactly. Marx says, no, that's not really risk. Volatility is measurable. Sure, you can calculate how much a stock price has jumped around in the past. But does that truly capture the danger? For Marx, true risk is something different. It's the probability of permanent loss. That's the key phrase. This isn't just a temporary dip in price that recovers. This is the chance that an investment goes down and never comes back. Or that you, the investor, are forced to sell at the worst possible time and realize that loss permanently because you need the cash or lose your nerve.
That feels much more consequential. Permanent loss.
It's the thing that truly matters, right? And a crucial part of his view is that this true risk, this probability of permanent loss, is inherently unquantifiable. You can't put a precise number on it beforehand, and often you can't even be sure after the fact.
Why not?
Because the future is uncertain. Randomness plays a huge role. Unforeseen events happen. So just because an investment did well doesn't mean it wasn't risky. You might have just gotten lucky. And just because an investment did poorly doesn't mean the decision was bad. You might have made a sensible, calculated risk that just ran into some bad luck.
So you can't judge the decision solely by the outcome.
Precisely. Assessing this true risk relies less on formulas and more on qualitative judgment, deep experience, thorough due diligence, really thinking through downside scenarios. It's more art than science.
Okay, so if we can't put a neat number on it, if it's more about judgment, how do we actually manage it? How do we get beyond just, crossing our fingers and hoping to the best?
This brings up a really important distinction Marx makes, the difference between risk control and risk avoidance. Risk avoidance would mean just refusing to do anything where there's a chance of a negative outcome, which, if you think about it, is impossible if you want to invest or, frankly, do almost anything meaningful in life. You'd never leave the house.
Right. No risk, no reward.
Pretty much. So risk control, on the other hand, is what he advocates. He calls it the intelligent bearing of risk for profit. It means you actively seek to understand the specific risks you're taking on. You decide which risks are acceptable because the potential reward adequately compensates you for taking them. And crucially, you actively work to avoid or minimize the risks that are not well compensated, or that could lead to that unacceptable permanent loss. Oaktree's main goal really captures this. They aim for superior performance, yes, but with less than commensurate risk. They want good returns, but they're explicitly trying not to take excessive amounts of risk to get them. It's about optimizing that risk-reward balance.
Intelligent bearing of risk. I like that. It sounds very deliberate, very defensive almost, like you're building fortifications rather than just charging ahead.
That's a great way to put it. This intense focus on risk control leads directly to what Marx calls a defensive investment posture. He talks about investing scared. Now, that doesn't mean being timid or paralyzed by fear. It means constantly being aware of what could go wrong, always worrying about potential losses, about the unknowns, about what you might be missing.
So it's a healthy paranoia.
Kind of, yeah. The main goal is to structure your investments, your whole portfolio, so that it can survive, maybe even thrive, under a wide range of potential negative scenarios. Loss avoidance is prioritized over reaching for the highest possible gain. This naturally leads to seeking asymmetry. You want investments where the potential upside is significantly greater than the potential downside. You want to participate meaningfully when things go well, but critically, you want to limit your losses when things go badly. The oak tree motto sums this up perfectly. If we avoid the losers, the winners will take care of themselves.
That's inversion.
Right.
Focusing on what not to do.
Exactly. Instead of obsessing solely about finding the next big winner, they put enormous effort into understanding and avoiding the things that cause permanent capital destruction. It's a powerful shift in focus.
That is so counterintuitive to how most people approach investing, which feels like it's all about chasing home runs. Marx is saying, just don't strike out.
Pretty much focus on defense first. And he has this really sharp, counterintuitive point about when risk is actually highest. It goes completely against what you might think.
Okay, let's hear it.
He argues that risk is often highest precisely when it is least perceived by the market participants. And conversely, risk is often lowest when it is most perceived.
Wait, say that again. Risk is highest when no one thinks there's risk.
Exactly. Think about it. When does that happen? During bubbles, right? When optimism is rampant, everyone believes stocks can only go up, credit is easy, and nobody seems worried about anything going wrong. In those moments, because everyone feels safe, they bid prices up to dangerous, unsustainable levels. They take on excessive leverage. They disregard warning signs. Paradoxically, by believing there's no risk, they are actively creating the conditions for a massive future loss.
Wow. So the feeling of safety actually creates the danger.
Precisely. And the flip side, when is risk perception highest? During crashes and panics, right? Everyone is terrified, headlines are screaming doom, people are selling indiscriminately. In those moments of maximum fear and pessimism, prices are often beaten down so low that the actual risk of further significant permanent loss is much lower. The bad news is already out. The weak hands have folded. Marx has that killer quote, "The riskiest thing in the world is the belief that there's no risk." It just perfectly captures this dynamic.
That's profound. It means risk control isn't just about analysis, it's deeply psychological.
Absolutely. Managing risk effectively requires immense behavioral discipline. You have to resist the powerful pull of the crowd, fight the urge to get greedy and complacent when everyone else is euphoric, and fight the urge to panic and sell when everyone else is terrified. You have to be the rational actor in an often irrational theater.
So it comes back to controlling your own emotions and thinking independently. And you mentioned he talks about other kinds of risk, too, not just losing money.
Correct. Beyond the primary fear of losing capital, Marx acknowledges other risks investors face. There's the risk of missing opportunities, often driven by that powerful FOMO, the fear of missing out when it seems like everyone else is making easy money. That can push you into bad decisions at the wrong time.
Oh yeah, FOMO's real.
It is. And then there's the flip side, the risk of taking too little risk. Being overly conservative might feel safe, but over the long term, it can lead to inadequate returns. You might not reach your goals or even keep pace with inflation. So the real challenge is finding that thoughtful balance between the fear of losing money and the fear of missing out. It's a constant calibration. Marx uses a quote from Elroy Dimson that captures the essence of uncertainty and risk beautifully. Risk means more things can happen than will happen. It reminds you that the future isn't a single path. It's a vast landscape of possibilities, and you need to be prepared for more than just the one you expect. Core philosophy the fourth. Navigating uncertainty, the limits of knowing.
Okay, this next principle from Howard Marks feels incredibly relevant today. We live in this world saturated with information, constant news cycles, and everyone, it seems, has a confident prediction about what's coming next. Market crashes, tech breakthroughs, political shifts, you name it. Marx, however, takes a strikingly different and much more humble approach. He basically argues that trying to predict the future with any kind of precision is, well, largely a waste of time.
Yeah, connecting this to his broader philosophy, Marx expresses this really deep, almost philosophical skepticism about our ability to forecast the future, especially on the big macroeconomic scale. He loves quoting the economist John Kenneth Galbraith, who famously said, "There are two kinds of forecasters, those who don't know and those who don't know they don't know."
Ouch. That's pretty blunt.
It is, but Marx believes it's fundamentally true. The future, he argues, is inherently unknowable. Not just difficult to know, but unknowable in any precise, reliable way. Why? Because there are just too many variables involved. Their interactions are incredibly complex, often nonlinear. The system itself is unstable. And then there's the huge role of randomness, luck, those completely unpredictable black swan events. So most forecasts, he contends, end up being just simple extrapolations of whatever's been happening recently. They're based on information that's already widely known and therefore already reflected in market prices. They offer no real edge, no useful insight for making superior decisions. They're often more about projecting confidence than achieving accuracy.
Okay, so if we accept that if we can't reliably predict what will happen, what can we do? How do we make decisions, invest, plan for the future in such an uncertain world without just throwing up our hands in despair or becoming totally paralyzed?
Yeah.
Seems like a tough spot.
It does, but this is where Marx offers a really crucial shift in perspective. Since precise prediction is futile, the focus has to change completely. It shifts away from trying to figure out what will happen to trying to understand what could happen. He emphasizes understanding the future not as a single point estimate like the market will go up 10% next year, but as a distribution of possibilities, a range of potential outcomes.
Probabilistic thinking, right?
Exactly. The intelligent investor, or any rational decision maker, doesn't claim to know the future. Instead, they strive to understand the plausible range of outcomes and then, importantly, try to assign rough probabilities to those different outcomes, however imperfectly. This replaces that impossible quest for certainty with a more realistic, more humble assessment of likelihoods. And this leads right back to that powerful mantra we keep hearing. You can't predict, you can prepare.
So preparation is the antidote to unpredictability.
That's the idea. Preparation, in this context, means building portfolios or making life choices that are robust. They need to be able to withstand a variety of different future scenarios, especially the unfavorable ones you didn't necessarily expect. It's about building resilience and flexibility, not relying on a fragile forecast.
This sounds like it demands a huge dose of intellectual humility, which I imagine isn't always easy to come by in fields like investing or, frankly, any competitive arena where projecting certainty and having all the answers is often seen as a strength. Admitting, I don't know, can feel weak.
You're absolutely right. This approach requires profound intellectual humility. It's a central, recurring theme in all of Marx's writing. I mean, just look at his memo titles, things like "Nobody Knows." He wears his uncertainty on his sleeve. Acknowledging the limits of your own knowledge and the limits of human knowledge generally is essential. Why? Because it helps you avoid that dangerous overconfidence that leads to so many big mistakes. It also makes you more aware of your own cognitive biases, like confirmation bias, where you only look for evidence that supports what you already believe, or overconfidence bias, where you overestimate your own abilities. Humility acts like a vital check against these mental traps. It keeps you grounded.
And he makes a really important distinction about what makes a decision good, doesn't he? It's not necessarily tied to whether it worked out well in the end. That seems like a crucial lesson for learning and improvement.
Yes, this is fascinating and so important. Marx stresses the critical difference between the quality of a decision and its ultimate outcome. A good decision, in his view, is one that was based on sound logic, thorough analysis, using the best information available at the time the decision was made before the future unfolded. But because randomness, unforeseen events, just plain luck play such a huge role in how things turn out, good decisions can sometimes lead to bad outcomes. It happens.
And bad decisions can sometimes get lucky.
Exactly. Poor decisions, ones based on flawed reasoning or lazy analysis, can occasionally lead to great results purely by chance. Superior investors, Marx argues, understand this distinction deeply. They focus relentlessly on maintaining a sound, disciplined decision-making process. They know that over the long run, consistently making good decisions increases the probability of favorable outcomes, even if individual results will vary due to luck. They learn to differentiate between skill and luck in their own results and when evaluating others. They don't get fooled by randomness.
So how does this translate into Oaktree's actual investment strategy? How does this philosophical stance on humility and uncertainty shape what they actually do day to day? It's not just talk, right?
No, definitely not just talk. This embrace of uncertainty actively shapes their entire investment approach in very concrete ways. It leads them to pretty much entirely disavow trying to make macro forecasts or time the market based on predictions about the economy or interest rates.
So they're not trying to guess the Fed's next move or predict GDP.
Not really, no. They see that as largely unknowable and not a reliable source of edge. Instead, they focus their time and energy intensely on what is knowable, or at least more knowable and controllable. What does that include? Deep, bottom-up fundamental analysis of specific companies, specific securities, specific industries, really understanding the details. It includes rigorously understanding the current market environment. Where are we in the cycle? What's the prevailing sentiment? What are valuations like? That situational awareness we talked about. And it involves relentlessly controlling risk within the portfolio using tools like margin of safety, diversification, and focusing on downside protection. It aligns perfectly with Warren Buffett's idea that useful information has to be both important and knowable. Marx and Oaktree essentially say, we don't know the macro future, so let's focus our efforts on the micro things we can analyze and control. Humility becomes an active, pragmatic strategy and not just a virtue. Core philosophy v. contrarianism and value price, psychology, and patience.
All right, our fifth and final core philosophy from Howard Marks. This one feels like it really ties everything together. The second level thinking, the understanding of cycles, the focus on risk. It culminates in this powerful, often counterintuitive strategy. Contrarianism combined with value investing. It's about daring to be different, but crucially, as you said earlier, also being right when you're different.
Exactly. Connecting all the threads, Marx is a huge proponent of contrarianism, which simply means thinking, and more importantly, acting, in opposition to whatever the prevailing consensus or herd behavior happens to be at the moment. His logic is straightforward. If superior results require diverging from the average, then doing what everyone else is doing guarantees average results. So contrarianism is a necessary condition for potentially achieving outperformance. But, and this is a huge but, he emphasizes, it's not sufficient. Just being different for the sake of being different isn't the goal. You can be different and wrong. That's disastrous.
You need to be contrarian and correct.
Precisely. Successful contrarianism has to be grounded in that superior insight we talked about, that second-level thinking. You need to understand why the consensus is likely wrong, not just reflexively oppose it. It has to be based on deeper analysis, a different perspective that holds up to scrutiny.
So it's informed opposition, not just knee-jerk reaction. And this clearly connects back to the market cycles and the investor psychology swings we discussed. It feels like contrarianism is almost the action you take based on understanding those cycles.
It absolutely is. The two are deeply intertwined. The contrarian stance is all about understanding and actively exploiting those predictable swings in investor psychology, the pendulum moving between greed and fear. The goal of the contrarian is to lean against those emotional excesses, not get swept away by them. Practically, what does that mean? It means having the courage to buy when fear is rampant, when assets are hated, when prices are depressed, and everyone else is panic selling. And conversely, it means having the discipline to be cautious, to reduce exposure, maybe even to sell, when greed and euphoria are dominant, when prices seem irrationally high and everyone thinks things can only get better.
Easier said than done, I imagine.
Oh, incredibly difficult. It requires immense emotional discipline to fight the powerful pull of the herd, and often to fight your own mirroring emotions. Marx often quotes Buffett's famous line, which comes from Benjamin Graham, "Be fearful when others are greedy and greedy only when others are fearful." It's the classic contrarian mantra. It's about acting precisely opposite to the prevailing mood, especially when that mood reaches an extreme.
And this practical application, acting against the crowd based on perceived mispricing, leads directly into value investing, doesn't it? It's not just about finding good companies, but finding them at the right price relative to their actual worth.
Indeed. The rubber really meets the road here with value investing. Specifically, the focus is relentlessly on the relationship between an asset's current price and its estimated underlying intrinsic value. Marx hammers this point home again and again. It's not what you buy, it's what you pay. That might be one of the most important sentences in his entire
You
philosophy.
say that again. It's not what you buy, it's what you pay.
Right. Investment success, he argues, comes primarily from buying things well, not just from buying good things. You can buy the best company in the world, but if you pay far too much for its stock, you're likely going to get a poor return. Conversely, you could buy a mediocre company, but if you get it at a dirt cheap price relative to its actual, albeit modest, value, you could make an excellent return. So value investing, in Marx's view, is essentially applied contrarianism. When you buy something for significantly less than its intrinsic value, you are usually doing so precisely because the market's collective perception reflected in that low price is overly pessimistic compared to the reality of the asset's worth. You're exploiting a temporary psychological misjudgment fueled by fear, neglect, or misunderstanding.
And a key tool for doing this safely, for giving yourself some room for error, is this thing called a margin of safety. What does that actually mean for you, the listener, in practical terms? How does it work?
What's fascinating here is the concept of the margin of safety, which, again, originates with Benjamin Graham, Buffett's mentor. It's incredibly simple but powerful. It just means deliberately buying an asset at a price that is significantly below your best estimate of its intrinsic value. This discount you demand isn't just about getting a bargain. It serves as a crucial buffer, a cushion against several potential problems. First, it protects you if your own estimate of intrinsic value turns out to be wrong, because valuation is an imprecise art. As Marx constantly reminds us, we make mistakes.
So it accounts for humility.
Exactly. Second, it shields you from unforeseen negative events that might happen, things you couldn't possibly predict that hurt the asset's value. Or just plain bad luck. It's maybe the most fundamental risk control mechanism in value investing. And critically, the larger the discount, the bigger the gap between price and estimated value, the greater your margin of safety, and the more protection you have. Marx quotes Seth Klarman, another great value investor, who said, "A margin of safety is necessary because valuation is an imprecise art. The future is unpredictable, and investors are human and do make mistakes. It's about building in that buffer, acknowledging uncertainty and fallibility."
Okay, this whole approach, being contrarian, focusing on value, demanding a margin of safety, it really sounds like it requires an enormous amount of patience. You can't just decide to be a value investor today and find bargains tomorrow. It feels like a waiting game.
You are absolutely right. Patience is not just a virtue here. It is an absolute strategic necessity. Executing this strategy effectively requires immense, almost superhuman patience. Why? Because those great opportunities where the price is significantly below intrinsic value, offering that juicy margin of safety, they're not always available. The market isn't constantly serving up bargains on the silver platter. Often it feels like everything is fairly priced or even overpriced.
So you have to be willing to do nothing.
Yes. Intelligent investors must develop the discipline to wait, sometimes for long periods, for those truly compelling bargains to appear. They have to resist that powerful urge, that itch to do something, to be active, when there's nothing truly compelling available. Marx has a great line for this. Sometimes the best action is inaction. It's hard, but often true. Furthermore, even when you make a correct contrarian value judgment, it can take a long time, and sometimes years, for the market to recognize its mistake and for the price to converge towards the intrinsic value. Prices can stay irrational or even get more irrational before reality eventually wins out.
So patience is needed both to find the opportunity and to see it through.
Exactly. It enables you to wait for the fat pitch and then to hold your position with conviction until the underlying value thesis plays out, even if it takes longer than you hoped. And Marx even gives some hints on where to look for these bargains. He suggests hunting among assets that are controversial, complex, frightening, unpopular, unloved, underperforming, or recently discarded by others.
Basically, places where the herd isn't looking.
Precisely. These are the areas where mispricing is most likely to occur because of neglect, fear, or misunderstanding. He also notes that buying from motivated sellers, people who have to sell for reasons unrelated to the asset's value, can create great opportunities. And he reminds us, tempering expectations. Underpriced does not mean going up tomorrow. It means you've likely found value, but you need the patience to wait for the market to eventually, hopefully, agree with you. It's a long game. Marx's philosophy beyond investing. Principles for rational decision-making.
Okay, we spent this whole deep dive exploring Howard Marks' wisdom, mostly through the lens of investing. But what's truly striking, and maybe the most valuable takeaway for many listeners, is how these powerful ideas really do transcend the financial markets. They seem to offer this almost universal toolkit, like an operating system for rational thinking. that you can apply to navigate complexity and make better choices in almost any area of life. So for you, the listener, what does this all mean beyond your portfolio? How can you use these principles in your career, your relationships, your health decisions, just your general approach to the world?
Yeah, if we step back and look at the bigger picture, Mark's principles genuinely provide a robust framework for rational decision-making in pretty much any complex domain. Let's quickly walk through how each one translates. Second-level thinking. Beyond just business strategy, like thinking about market saturation or competitor responses, in daily life, this means constantly considering potential unintended consequences. Think about a new policy at work, or even a personal decision. What are the ripple effects? In personal life, it's about looking past surface interactions to understand deeper motivations or relationship dynamics. It's the discipline of always questioning the obvious answer, asking why multiple times, digging for the underlying reality. It combats simplistic thinking.
So avoiding knee-jerk reactions in any situation.
Exactly. Then, understanding cycles and psychology. This isn't just for markets. Think about social trends, political moods, the hype cycle for new technologies, even morale within a team or organization. These all tend to move in cycles of enthusiasm, disillusionment, correction, and eventual stability or renewal. Understanding where you are in that kind of cycle, whether people are generally optimistic or pessimistic, open to change or resistant, can inform your timing for launching a project, suggesting an idea, or even how you lead and manage people. It provides crucial context.
Right. Sensing the mood of the room or the organization.
Precisely. Next, risk assessment. Applying Marx's definition, focusing on the probability of significant, negative, potentially irreversible outcomes is vital everywhere. In career planning, is specializing too narrowly creating a risk of permanent obsolescence if the field changes. In health decisions, focusing on preventing catastrophic health failures, not just minor aches. In managing a big project, identifying and mitigating those few critical risks that could sink the whole thing, not just cause minor delays. It's about avoiding wipeout risk.
Focusing on avoiding the truly bad outcomes.
Yes. Then, intellectual humility and uncertainty. Acknowledging you don't know everything is fundamental in science, medicine, law, almost any field that deals with complexity. It fosters open-mindedness, adaptability, and that crucial focus on preparation over rigid prediction. In personal judgments, it breeds empathy. It makes you less dogmatic. And valuing the decision process over the immediate outcome, that's huge for learning and resilience. If you only judge decisions by results, you'll learn the wrong lessons from bad luck and good luck.
Learning from the process, not just the score.
Absolutely. Then, contrarianism and value. Questioning conventional wisdom is the engine of innovation in any field. If everyone thought the same way, we'd never make progress. Identifying undervalued ideas, overlooked problems, or neglected approaches, that's how breakthroughs happen. And thinking about price versus value applies everywhere. What's the price? Effort, time, cost, risk of pursuing a certain goal or activity versus its potential value, benefit, learning, impact. It's a fundamental calculation for allocating your finite resources, your time, energy, money.
Making conscious trade-offs.
Right. And finally, patience. Resisting impulsive action, letting situations develop, waiting for the right moment. Critical everywhere. Think about negotiation rushing often leads to bad deals. Long-term planning requires resisting short-term distractions. Skill development demands perseverance over years. Building strong relationships takes time and trust. Patience allows things to mature and unfold.
So these aren't just investing rules. Marx has basically given us a mental toolkit, an operating system for rational thought that works across the board, whether you're facing a career crossroads, a family decision, or just trying to understand the world better.
Exactly right. His constant emphasis on continuous learning, on rationality, on discipline, and especially on understanding human behavior, our own and others, provides these truly enduring lessons. It's less a set of rigid rules and more a flexible, transferable framework. It helps you process information better, assess situations more clearly, understand those powerful human tendencies, and ultimately make more reasoned, adaptable decisions, especially when you're dealing with incomplete information and an inherently uncertain future. He even said himself, underscoring its importance, something like, the discipline that is most important is not accounting or economics, but psychology, because at the heart of almost every complex system, whether it's markets or society, is human behavior. Understanding that is the real key. Outro. So at the end of the day, what Howard Marks really offers us is an invaluable way to approach the world. It's a method for thinking more clearly and acting more rationally. By internalizing and thoughtfully applying these principles, you really can gain a significant edge, not just in financial markets, but in pretty much every complex decision you face. This commitment he models to deep thinking, to understanding human nature, to disciplined action, it truly lays out a path for navigating this inherently unpredictable world we live in. It helps you focus your energy where it matters most.
Wow. What an incredibly rich deep dive today into the insights of Howard Marks. It's so clear that these tools he developed for investment success are actually fundamental life skills. Skills for anyone seeking more clarity, better judgment, and maybe a little less anxiety in a complex world. We genuinely hope this exploration has given you a lot of practical ideas and strategies to mull over and maybe start applying. As always, we hope this deep dive helps you navigate your own complex decisions, whatever they may be, with a bit more confidence and insight. And just a reminder, if you want those daily insights into market temperature using that key valuation lens, you can easily search for and download the Buffett Indicator app. It's right there on the Apple App Store. Also, if you found this valuable and want more in-depth analyses like this, please do subscribe to our full deep dives on the Deep Value Investing channel. Find us on Apple Podcasts and Spotify. Oh, and don't forget that book list in the episode description if you want to explore these ideas further. One last time, the important reminder. All analysis today was based on publicly available sources purely for educational purposes. It is not investment advice. Please, always conduct your own thorough due diligence before making any investment decisions. Thank you so much for joining us on the deep dive, and we really look forward to our next exploration together.